Interest rates are falling, but for most Canadians, buying a home still feels impossible. Why? Because this isn't only a rate problem anymore, it's a broken system. And experts say it could take a decade or more to fix. So if you're hoping for a quick turnaround, think again. Hey everyone, welcome back. Today, we're digging into a tough but important topic: why housing affordability in Canada still sucks, even after the Bank of Canada started cutting rates. If you're a real estate investor, a first-time buyer, or just trying to make sense of this wild market, you're in the right place. Let's dive in. Rate cuts versus reality. The Bank of Canada has lowered its key rate to 2.75%, down from 5% a year ago. Sounds like good news, right? But here's the kicker. The monthly cost of owning a home has barely changed. Why? Because prices haven't come down, and mortgage stress tests are still alive and well. Take a typical $700,000 home today, compared to a $500,000 home in 2020. Even with today's lower rate, your mortgage payment is still 40% higher. Lower rates are like a band-aid on a bullet wound. But here's the upside. If you know where to look, opportunities are still out there. Investors' takeaway: don't chase headlines about rates. Focus on markets where prices are flat but rents are rising. Think Calgary, Ottawa, or Halifax. If you find this helpful, hit like, subscribe, and share it with another investor or homeowner who needs to hear the truth about Canada's housing market. It helps more than you know and lets us keep delivering smart, data-driven breakdowns. All right, let's keep going. Prices versus income, the gap widens. Since 2020, home prices are up more than 30%. Meanwhile, real disposable income, just 2.3%. We're now at a national price-to-income ratio of 9x, the worst affordability in Canadian history. The historical norm, 4 to 5x. This is a massive red flag, especially for first-time buyers. But for investors willing to hold and build thoughtfully, this demand shift creates long-term tailwinds. Supply is the real issue. Here's the core problem: we're not building fast enough. Canada needs 3.5 million new homes by 2030 to restore affordability. We're on pace to miss that by 1.5 million. Why? Outdated zoning laws, years-long approval processes, and construction costs at $400 plus per square foot in cities like Toronto and Vancouver. Investor tip: target cities with fast-tracking development like Hamilton, Halifax, Edmonton, and avoid places where NIMBY policies choke supply. Don't expect a quick fix. Yes, we're in this for the long haul, but long-term strategies still win in long-term markets. Playing the patient game now could pay off big later. Unless supply and incomes rise significantly, housing affordability won't improve for 10 plus years. Relying on interest rate tweaks alone is just kicking the can, says RBC. That means flipping properties right now is risky, especially in overheated markets. Investor strategy: think long-hold rentals, land banking, and build-to-rent models that hedge against future volatility. So what actually fixes this? Here's what needs to happen and where you can get ahead as an investor. 1. Open up land access and speed up permitting. 2. Ban single-family zoning near transit. 3. Support wage growth for working Canadians. And 4. Expand CMHC-backed multifamily programs. Watch for policy shifts. Cities that embrace density and fast-track approvals will win, and so will their investors. Programs like CMHC MLI Select, still one of the best ways to scale rental portfolios in tight lending conditions. Which of these solutions do you think will work best? Drop a comment below. I want to hear from you. And if you're serious about smarter, safer real estate investing in Canada, hit subscribe and follow me on Instagram for weekly insights built for this exact market. Next week, we will start diving into 3 cities where rent could double by 2030. You don't want to miss it.